Something else that has changed is anybody who is putting something aside for their post-retirement medical, you are also being exempted up to a limit of 15,000. Now, as you do your calculation at the end of the year, remember what we do at the end of the year, you file tax. You can also indicate that you also put something, you have a private pension and you also put something towards your post-retirement medical, because we also retire. So that one can also reduce your taxes significantly.
Hi everyone, I hope this video finds you well. My name is Martin, in case you're here for the first time. Na sisi ni watu wa insurance. We do civic education as well as reviews on insurance, especially in the Kenyan market. Now, we have been on a small break, a few days. We had a few things we wanted to settle, but we are back like we never left. And we want to continue from where we left in our previous video. Although nili post another video in between, but we want to continue from where we left kwa video pension. We were talking about pension and tax, and especially for those people who want to withdraw their pension and hawajafikisha miaka ya retirement, that is the age of 50. And we were talking about we were looking at someone who hasn't worked for more than 15 years. That is maybe 10 years or so. Umesema umetoka kwa formal employment, you decided to go your own way and you want to withdraw your pension. So what are the tax implications? And we covered that. And if you haven't watched that video, go back and watch, and I'm going to leave a link to the videos in the description box so that you can catch up with this video. Now, in today's video, we want to continue with the same discussion, but now looking at now the new tax law. Is it new tax law? Yes, because we were looking at before they amended, because now we are talking about there are changes which are going to be affected this month. That's true. So the previous video we were looking at the old version, but now in this video we want to look at the new version. So if you haven't subscribed, be part of this community. We are trying to give you as much as information as we can in regards to insurance. Na kama uko na swali, we always appreciate that you write the question in the description box, because we want to educate you as much as possible and to help you enjoy insurance. So without wasting much time, I want to invite my guest, not my guest, my partner, so that we can have this conversation. Like this video, subscribe, share and leave a comment. Let's get into the video. So karibu sana Bwana Mwai.
Thank you, Martin.
Yes.
And to our audience, again, I'm delighted as always to be part of this great community where we discuss matters, insurance, pension, and more so on educating you on the best way you can be able to make decisions relating to investments. And for those people who are said possibly to retire, we also want to give you something that you can look into or look upon, so that you avoid some of these hefty taxes. And last time, just like Martin has told us, we looked at if, for example, you've worked in an institution for 14 years and below, and you want to move out, yeah, and not forgetting your pension, of course, you want to withdraw the same pension. What were the tax implications? Where we say, just to do a recap, that as long as you have not reached 15 years, as per the old laws, which are now out, and we shall introduce the new tax law in relation to pension. Before, you are paying tax in this format, that is the employee and the employer. So the employee was paying the first 288,000 was exempted, but going forward, the next 200,000 you are paying tax 10% rate. The next 200,000, 15%, all the way up until you get to 888,000. any amount above 888,000, you are charged 30%. That is when a person have worked for less than 15 years in the same scheme, and you mark that in the same scheme. So that you don't say, well, I've been in this institution for 10 years and this other institution possibly for 6 years. That is not 15 years. They were counting 15 years cumulative. Yeah. But
so just to maybe put it more practically,
yes,
when we talk about same scheme, assuming maybe if we can say company X,
yes,
you have worked for that company for more than 15 years.
You have worked in that same company for the same for 15 years.
15 years.
Yes, that is when
you'll be exempted.
You'll be not really exempted. Your tax bracket will be broadened.
Oh, okay.
Yeah.
Okay,
So
okay.
and what we this is now for persons who are below 15 years. Now above 15 years. 15 years now we are discussing as per the old tax code. Yeah. So what happened is this: the first 600,000, as long as you had worked for above 15 years in the same scheme, or you had reached the retirement age, which usually is 50 years. Yeah. When I talk of that age, you will note there's some kind of reduction in terms of years. Now you can be exempted from paying tax. But this is someone who had worked as per the old laws. If at all you had worked for 15 years, you are exempted from paying tax, the first 600,000. If, let's say, you had 2 million, yeah, if you had 2 million, the first 600,000, you are not being charged for tax, but the next 400,000, you are being charged at 10%, 400,000, another 400,000, 15%, another 400,000, 20%, the next 400,000, this is 25%. So any amount beyond 1.6 million, we were being charged 30%. So that was the difference. That was then. That is before 2024, December date 27. This was the law.
Okay.
Now we want to look at what has changed and how it will affect you if you want to withdraw your pension. What we are saying is this. This is old, just to do a generalization or a general overview, and this is new law. So for the old law, anybody who had reached 65 years, you are not paying tax. You are paying 0% tax. But in the new law, as long as you have reached at least the minimum retirement age, which is usually 50 years, and you want to withdraw your pension, you are withdrawing it at 0% tax rate. However, I must put a disclaimer: there are a lot of other hidden things. So another situation when you were exempted from paying tax in the previous tax regime is when you are critically ill, or disabled.
Permanently disabled.
Yes, permanently disabled. Those were only 3 options.
Age, critical illness, and disability. Permanent disability.
Good. So today, the same thing will apply. However, let me say this. Previously, so that you pay 0%, the only option was this. As long as you are full, this was the only occasion when you want to pay 0% tax. Now today, as long as you have reached that 80 years, this is the minimum age that is considered a retirement age. However, you must have worked in the same institution, or you have been in the same pension scheme for at least 20
20 years.
Yes.
As in you got employed at the age of 18. And you have worked for the same company.
Yes, for at
least
until
the age of 38.
Until the age of 30, that is 20
years.
However, let me put this openly. If let's say you have worked in a company A for 10 years and you have moved to a company B, worked for 15 years, that is not 20 years as per the government. Because that is not cumulative. They are saying you'll only enjoy zero tax. Yeah? And zero tax is only on what? On the lump sum. Because ordinarily, a majority of the institutions, you get something called pension. Pension is divided into two parts. You have 1/3 and you have 2/3. This 1/3 is what you are being exempted from paying tax if you are critically ill, number one. Number two, you must at least have worked in the same institution
for
20 years minimum, which is quite rare. Not unless you work in, let's say, a TSC, Mwalim, or forces. We call them who? The police, the jeshi, and those are able to at least stay in one institution for at least 20 years. But others, you will find that you worked in this institution for 2 years, you've gone to another institution for 3 years, you have gone to another institution for possibly 10 years. That is not 20 years. Even if all the years you've worked is 20 years, the government is that you must be in the same institution for at least 20 years for you to be exempted from paying tax on your lump sum. But the 2/3 ordinarily, in the previous tax regime, you are also paying what we call tax on annuity. For those who don't know what annuity is, this is the plan you buy, and it's not tafadhali. You buy it from an insurance of your choice upon receiving the first third, 1/3 of your lump sum amount. Let me use a practical example. Let's say you have 5 million accumulated. The first third, which is around how much? 1.75 million. 1.75 million, you were charged tax as per, I think we've discussed that in the previous video, but the 1/3, this is how you are being taxed. The first 600,000, you pay 0%. The next 400,000, you pay 10%. The next 400,000, you pay 15%. All the way until that money hits 1.6. Yeah, and the balance now, because yours is 1.75, we can put that aside and focus possibly on the remaining, the big chunk, 2/3. 2/3, you don't have a choice as an employee. You must buy an annuity. An annuity is an insurance plan you buy using that lump sum, which will be paying you on monthly basis until death.
So, are you given this money for you to go and deposit with an insurance company?
No, it is transferred, because ordinarily what you'll find is any institution don't really have a bank account they put this money. Any institution have an insurance company in existence where they put this pension. Now, that pension, if your employer was in company A insurance and you've retired, you have a liberty to move that fund to any other company, insurance company of your choice. But what used to happen is you are also paying tax because it was an income. As much as umeretire and you are receiving that monthly income, you are paying tax from this. The first 25,000, maybe you can assist me.
Let me.
Yes. So Yeah. So the first 25,000, and let me use mathematical example. If we have this guy who have 10 million accumulated amount by the time they were hitting 60. So what would happen? So if you have 10 million, apologies for that, you have 10 million, and assuming you've already taken your first that, and what is left is 10 million. Usually, because this is what you are advised to buy annuity, what you'll be getting approximately is 1% per month, 1% of the lump sum. If you have 10 million, average of 100,000, that is the monthly pay you'll be receiving each month. Now, this 100,000, still you are paying tax. How much? The first 25,000, you are paying 0% tax. Now, from 25,000 up to the next 32,888, you are paying, I think, 10%. But this one I can verify in our next video, because we are not yet done with these episodes. So up until this money is exhausted. So this is how tax code was being applied on the previous NNE. But now there are some few things that have changed. One of the things that have changed is, if you have hit the retirement age and you bought your annuity, you are paying 0% tax. So something else that has changed is anybody who is putting something aside for their post-retirement medical, you are also being exempted up to a limit of 15,000. Anybody who is putting pension today, it has been increased from 20,000 to 30,000. Yes,
that is the capping.
That is the capping.
Ebu explain here this capping.
So this is what used to happen. In the past tax for pensioners, every month, if at all you are putting, let's say 30,000, the maximum amount of money you are being, which was treated as tax deductible.
Or tax deductible.
Tax deductible is any amount that is, first of all, removed before the pay is computed. That is what we call tax deductible. So,
or in other words,
yes,
the month that is not subject to tax.
Good. So previously, the maximum amount that you are exempted from paying tax
is
20,000, and this is for pension.
Yes.
Now 2025, they have increased it to 30,000.
So you get your gross.
Yes.
They first of all get 30,000.
Yes.
And then the rest is subjected to tax.
Good. Assuming you are earning 100,000. So what they do is they remove the 20,000, meaning that you've been left with 80,000. That is what will be subjected now to
tax. Oh, okay.
Today, instead of removing 20,000, they are removing 30,000. So 70,000 is what is subjected to
tax. Okay.
Yeah. So and that is a benefit to you as an employee. But majority of us want to put the least amount towards pension. But my advice would be, if you want free money, take advantage of this tax code. And there are only two ways as an employee you can take advantage. Number one, put more on your pension, because there is a general cap. Or the maximum amount of money you'll be exempted is 30,000. So if you have been putting 10,000, put at least 15,000. That one will exempt you more tax. And another thing that you can take advantage of, and you'll get this as free money, is when you are putting towards your post-retirement medical. So initially, even if you were putting 100,000 towards your post-retirement medical, there was no tax exemption. But today, they have capped that today, if you put maximum 15,000, it will also be treated as a tax deductible, meaning that kwa ile pension yako wanatoa, then wanatoa your post retirement medical, wanaweka kando, so you will still reduce the amount of pay you usually pay.
And I think it's good to mention,
yes,
I don't know whether that's a new development here, post medical.
Yes.
Because that was one of the biggest worries for retirees.
Good.
Because once before kitambo ilikuwa once you retire you are what, unatolewa kwa medical ya kampuni,
yes,
which becomes a very big burden for most retirees.
Yes.
Sababu kama ulikuwa unalipiwa hospitali na kampuni, now you have to take care of that.
Good.
So saizi, is it optional for someone to take a post retirement medical?
Yes.
Is it something which is optional or mandatory?
It is still optional.
Yeah.
So the advantage, we've had institutions which have adopted that method, that as long as you are working for us, we shall buy, not an option, we shall be deducting something from your pay to take care of you once you retire. And that money will be used to buy your medical cover until you die. One of the institutions is Jeshi. So what happens is, as you are usually deducted some amount of money until you hit around 45 years, and then it stops. That money will be invested somewhere. Once you retire, the medical cover, your individual medical cover kicks in. So today, because it is still not, it is an option. It's an option you can take.
Yes.
You can instruct your HR to be putting something aside for you towards your post-retirement medical. That one automatically reduces your tax. And that is an advantage for you as an employee, so that you can be able to reduce these taxes as much as possible by 2 ways. One, think of putting maximum towards your retirement, that is pension, and you put maximum now, which is capped at 15,000, to take care of your post-medical retirement, and still that one will automatically be counted as a tax deductible. So as long as you have worked in the same institution for 20 years cumulative, that is when you'll be exempted from paying tax. At that point, you'll pay zero on your lump sum withdrawal.
That is 1/3.
That is 1/3. But the 2/3, you still don't have an option. What you'll do, you'll be forced to buy an annuity, whereas on the same annuity you'll not still pay taxation. Yeah. So again, another condition that has been introduced is when you have, did I say critical illness?
Yes.
Yeah, critical illness and disability. But the age at which you can retire now has been lowered. Yes, up to 38 years. 38 years, meaning, but with a condition that you must have worked for 20 years.
For someone who is not working in a formal sector, but maybe they would want to, kuna kitu mention hapa hivi ni post retirement medical.
Yes.
Someone who is not in a formal sector but would maybe want to enroll to such a an arrangement.
Good. So again, the new Nini has brought us something good for as long as, or even if you are not employed formally, because they introduced also an exemption on persons buying IPP or individual pension plan. Now, as you do your calculation at the end of the year, remember what we do at the end of the year, you file tax. You can also indicate that you also put something, you have a private pension, and you also put something towards your post-retirement medical, because we also retire. So that one can also reduce your taxes significantly. Yes.
Okay.
Yes.
All right.
Yeah.
So I think we have tried to cover as much.
Yes.
But because I don't think we can be able to cover everything for pension in one video.
Yes.
I think I would encourage our viewers to keep sending questions.
Yes.
Maybe kuna kitu maybe to mention, and maybe someone needs clarity,
Yes.
you can send those specific questions, not unless you have something to.
No, what I would urge our viewers, keep supporting us.
Yes.
The only way we can keep on posting this is when you show us interest.
Yes.
And I can tell you we have a lot of material that
Yes.
is helpful.
Yes.
That can help us make decisions. And I believe our viewers, because their age bracket is wanye wako hapa katikati, you could be having a parent who is almost retiring.
Yes.
And you would want us to advise them on the best way after retirement.
Yes.
Yeah, we are here to guide them, and we shall not charge a penny. Yeah. So for annuity, for income drawdowns, those are two of the options you have as a retiree.
Yes.
So that it can sustain you continuously after retirement.
I think that can be a very interesting subject.
Yes.
Maybe we can cover in the later videos.
Yes.
Because we normally say retirement is just a new phase you're getting into. It doesn't mean life may stop.
Agreed.
You are starting something new.
A new journey.
A new journey.
Yes, actually you've just transitioned.
Yes, yes.
From working for somebody now to looking
managing
at
yourself without an income.
Yeah. So that is why it is very important.
Yes.
You have someone you can sit down with and we evaluate which is the best way to manage what you'll get as your pension.
Yes.
Because one of the biggest mistakes we make is at retirement. You are making these decisions in a panic mode.
Yes.
Yeah, because most likely you are not prepared. At the same time, it's a very, very new thing. You know, when you retire, you are alone. You are left alone.
Yes.
So if you are not careful, sometimes you spend a lot of money trying this, trying that. If it fails and that is your last resort, we all see what happens.
Yes.
And we would not like you to experience that.
Yes.
Because your parent is also our parent.
Yes.
And we would want them to make the best decisions.
Yes.
And decisions that can actually impact children or those who will be left positively.
Yes.
Yeah.
And I think it's important to say that this information is not necessarily for old people.
Yeah.
Even young people, you can make the right decisions when you're still young.
Sure.
To avoid the last minute rush.
Yes.
So do not feel like even at the age of 35 or 40, like this information is not for you. Always feel free to send us those questions, and we'll be able to do a detailed video for them.
Yes.
Because we want to help them understand these things before they buy.
Good.
So thank you very much. That was quite something. I hope we have been able to give you value for your time. And if you haven't subscribed, I think this video gives you a reason to subscribe. We want to give you as much as we can, but first of all, show us interest, subscribe, like, share, and leave a question and a comment in the comment section below. And until we see you in the next video, God bless you and
Bye.
bye.
Thank you so much.
Asante sana.